Welcome to a video on recognizing revenue over a period of time. Remember in the last video, the company Peloton delivered the equipment, and that was the fulfillment of the performance obligation. So at that single point in time, when they delivered the equipment, they recognized revenue. Let's look at another aspect of the business of Peloton. So revenue recognition for sales contracts satisfied over a period of time will result in recognizing revenue over a period of time. So examples of these are lending money. The interest revenue is recognized daily. Performing audits. We recognize the revenue as we do the audit work. And providing consulting services is another example. Construction projects are yet another example. So here's the rule. Recognize revenue. Revenue is recognized over time when any of the following are true. 1, the customer consumes the benefit of the seller's work as it is performed. Examples here, cleaning services. We recognize revenue after each weekly cleaning. Six Flags, they recognize revenue for season passes each period after the park has been made available to the season pass buyers. Another reason revenue can be recognized over time is the customer controls the asset as it is created. An example here would be a contractor building an extension onto a customer's existing building. Finally, another reason revenue can be recognized over time is when the seller is creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payment for progress to date from the customer. This is an example when Boeing builds a fighter jet for the U.S. Air Force. Boeing doesn't need fighter jets for its business. So, what if one of these isn't true? If the contract does not meet any of these three criteria, the revenue will be recognized when all the performance obligations of the seller are fulfilled. In other words, when at the end, when the fighter jet is delivered, when the extension on the building is complete and it's opened up for business. Okay, let's look at an example in our example with Peloton, the Peloton operations. Peloton sells one-year subscriptions to the Peloton multi-user platform of internet-based workouts for $600 per year or $50 per month. Now, I should say, since Peloton is a well-known company, I have no idea if this is even in the ballpark. I used these numbers because it was $50 a month. On January 1, 2024, Peloton sold a subscription. Under the terms of the agreement, Peloton is obligated to provide its service to subscribers by allowing the customer access to the online workout platform until the end of the year, December 31, 2024 at midnight. So the requirement of the case is show the journal entries with the appropriate dates for these economic events. Peloton prepares monthly financial statements for internal purposes and quarterly financial statements for external financial reporting purposes. The reason I added that clause is to say that Peloton is earning this money by the minute, by the second, certainly by the day. So the company could get as granular as it wanted in when it recognizes revenue. But the absolute minimum is monthly, because that's when they're preparing financial statements that need to be accurate and reflect the economics of the business. Okay, so as always, I hope now that you will pause the video and do the prepare the journal entries, complete the case, and then come back and I will discuss it with my solution. All right, welcome back. Okay, so on January 2 of 2024, we received the cash from the customer, an excited person that's going to fulfill their New Year's resolution of working out on their Peloton equipment. And so they bought the subscription. I apologize, a little error in here that I just noticed. And the amount is $600. Debit the asset cash. And in this case, remember, we're crediting a liability. We haven't earned anything yet. If that system crashes, we got to send that $600 back to the customer, back to the subscriber. All right. Now on 130, remember I said that at the absolute maximum amount of time we can let go before we recognize revenue is the month, because we're going to prepare monthly financial statements. So at the end of the month, we record revenue for what we've earned so far, 50 of the 600. Doggone it, I apologize. For 1 month. And then obviously we're going to do that every other month. So literally rather than have you write journal entries for the end of February, March, April, May, June, July, August, September, October, November, December, I use this shorthand notation that we will be doing the same thing at the end of every month to record revenue for the $600. And you will see the declining balance in the deferred revenue account going from $600 to zero as it is all earned over the year. Okay, now a brief addendum to this case is recognize revenue over time when progress isn't so linear, isn't so obvious. With Peloton, the progress of revenue earning is a function of the time. It's happening every second, every minute, every day, every month. In other business models, it can be less clear how much progress has been made towards fulfilling the contract and completing the project. Two models will commonly be used. So what we're talking about here is the company does have one of those criteria met. That means they can recognize revenue over time. But the issue is, how much progress have they made? So there's two general models we will use to objectively determine how much revenue to recognize in the current period. The first type is an output-based model. Output-based. And then the other one is an input-based. With an output-based model, an example is building a 10-story building. We might recognize revenue by story completed as we go up. 1/10 every time we complete one of the 10 stories of the building, one of the 10 levels of the building. That's an output-based model. The output is the building, And as the building goes up, we recognize revenue accordingly. The other one is an input-based model. This one, for example, might be relevant for a service project. In an input-based model, here's some examples. Total hours completed this period as a percentage of the total hours expected for the project. Or total costs incurred this period as a percentage of total costs expected for the project. Or any other relevant, meaningful metric that is correlated with the degree to which we have completed the project. And so that is for recognizing revenue over time when the progress is more difficult to ascertain and discern. Hey, thank you for your attention. And now we're going to turn our attention in the next video to when there's multiple performance obligations. Thanks again. Have a great day.